Let's take a look at the term structure of interest rates. So the term structure is the relationship between the time to maturity and yield to maturity, all else being equal. So in a previous video, I've discussed how you compute yield to maturity, and I'll provide a link below if you need to see that. So when we do this, we want the bonds to be similar, identical essentially if we can. So it's important to recognize that we pull out the effects of default risk and different coupons, etc. So usually we use treasury bonds because they're considered to be default risk-free, and we can, for example, strip out the coupons and make them zero coupon bonds. The yield curve, which you hear mentioned a lot of times when we discuss term structure of interest rates, is a graphical representation of the term structure. So the normal yield curve is upward sloping. That is, long-term yields are higher than short-term yields. An inverted yield curve has a downward sloping, and has long-term yields that are lower than short-term yields. So let's take a look at a picture here. So that this would be sort of a normal one. You'd expect it to be upward sloping. Longer time to maturity, higher the interest rate. The red one is the inverted one. So longer term to maturity, shorter or lower interest rates. Why an inverted yield curve? Well, people have actually found, doing research, that the inverted yield curve tends to be a reasonably good predictor of recession. It doesn't always happen, but when the yield curve inverts, it may be a warning sign the recession is coming. Why? Because if the economy is not doing well, it's likely that the Fed will be lowering interest rates in the future, pushing down or causing rates on longer-term bonds to be lower than on shorter-term bonds. And of course, we can have a flat yield curve, that is, the rate is the same regardless of the time to maturity. So let's take a look at a few theories of the term structure. The expectations theory says long-term rates reflect current short-term and expected future short-term rates. So the long-term rate should be an average of the current and the expected future short-term rates. So let's take a look at an example. If the rate on a one-year bond is 10% and the one-year rate is expected to be 12% next year, intuitively you would expect the annual rate on a two-year bond to be 11%. Why is that? Well, if you were the one buying the bond, you wouldn't lock in to 10% for 2 years if you thought the rates were going to go up next year. And the person issuing the bonds is not going to give you 12% this year when rates are 10% this year. They're going to likely give you the average of the two. So mathematically, we're saying that 1 plus the rate on a 2-year bond right now squared, so this is compounded for 2 periods, equals 1 plus the rate on the 1-year bond right now times 1 plus the rate on the 1-year bond expected in year 2. So if we do the mathematics of this, we get that R2 is going to be equal to, by doing a little algebra here, 1 plus R1 times 1 plus R1 expected next year. It's going to be raised to the 1/2 power minus 1. Okay, the reason it's the half power because we have 2 years here. If we had 3 years, this would be the 1/3 power. If we had 4 years, this would be the 1/4 power. So if we had 4 years, you'd have the rate this year on a 1-year bond, and then times 1 plus the rate expected next year, times 1 plus the rate expected in 2 years from now, times 1 plus the rate expected 3 years from now, et cetera, et cetera. So if we do the math here, we get 0.10995, or it rounds off to 11%. So it works out to what we intuitively thought it would be, that it should be the average of 10 and 11%, and it turns out to be actually 11%. Let's take a look at a couple of other theories of the term structure. There's the liquidity premium theory. And this is something of an offshoot of the expectation theory. So the liquidity premium theory asserts that long-term interest rates not only reflect investors' assumptions about future interest rates, but also include a premium for holding longer-term bonds. Okay? That is, investors prefer short-term bonds to long-term bonds, and we call this the liquidity premium. Okay? Longer-term bonds are riskier. If interest rates were to go up, the price of a long-term bond would go down more than a short-term bond. And when you lock up your money for a long time, you're taking some risk. So people want a premium for holding on to longer-term bonds. So even if you expect interest rates to remain the same for the next 30 years, it's likely, according to the liquidity premium theory, that the yield curve would slope upward. The third theory of the term structure is what's referred to as the market segmentation theory. So this is a theory that says that long-term and short-term interest rates aren't really related to each other. They're determined by their own markets. And if you think about it, it kind of makes sense. If you're getting a 30-year mortgage, what does that have to do with a 90-day treasury bill? Not very much. You don't really care what's going on in the 90-day T-bill market. You only care about what's going on in the 30-year mortgage market. So supply and demand in each one of those markets dictates what the rates are in each individual market. I guess I shouldn't say the problem with this, but the problem with this is it doesn't actually tell us what the yield curve is likely to look like. The expectation theory tells us what the market thinks rates will be in the future. The liquidity premium theory says that longer-term rates should have a longer-term bond should have a premium attached to them. But the market segmentation theory says that rates are determined in each individual market. So that's how the term structure works. And remember, the yield curve is a graphical representation of this. And I don't see it anymore, but the Wall Street Journal used to publish every day the graph of the yield curve, and they usually graphed it, 1 day ago, 4 weeks ago, and maybe a year ago, and you could kind of see were there any changes. They did that in their, I think it was called Money and Investing section, and they did it every day. Okay, I don't see that anymore, but it was quite popular for years and years and years. They used to have it usually on the front page of that Money and Investing section. So I hope you found this useful, and thanks for watching.